against the rest of the market, which means the price should be trending upwards. The VIX is the S&P 500's volatility index, which measures how much prices are expected to move up and down based on options contracts over the next 30 days, which means this is a forward-looking indicator. The VIX usually drops when the market is moving up, and it skyrockets when stocks start to crash. That means its 50-day moving average tends to be lower in bull markets, higher in bear markets, and has huge spikes that signal extreme fear. So when the VIX stabilizes after a big spike and market momentum starts trending toward or above its average, that's when I start buying more aggressively. Alright, so far we've covered why tariffs cause stocks to crash, looked at how long crashes take to recover, and found a way to tell when the market is being greedy or fearful. Now with all that context, we can talk about which stocks to buy as a result. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to make more content like this. Thanks, and with that out of the way, let's get into the stocks. In my opinion, every great long-term portfolio starts with a fund, especially if this is your first market crash or you just want to play it safe. Everything we've looked at so far tracks the S&P 500, but it applies just as much to the Nasdaq 100 since they have so many stocks in common. But the Nasdaq only has 100 companies instead of 500, so it makes higher highs in bull markets and lower lows in bear markets, which is exactly what we're looking for to buy low while others are panic selling. One of the big challenges with tariffs is that increased prices often get passed on to consumers. A study from the National Bureau of Economic Research found that the costs of President Trump's trade war in 2018 were passed entirely onto importers and consumers. Rising prices means lower spending, which means lower earnings for companies, and ultimately lower stock prices. That means companies advertising or selling things directly to consumers are especially sensitive to tariffs. But that also means they have the most upside if you believe these tariffs won't stick. On the advertising side, Google is trading at a price-to-earnings ratio of 18, which is the lowest PE ratio it's seen in 2 years, and the second lowest in over 10 years. The only time Google was trading cheaper than this was at the end of 2022. And according to discounted cash flow models like Simply Wall Street's, Google is currently 43% undervalued. Said another way, Google stock would have to go up 77% to hit its fair value today. That's a 77% upside. Like I said, millionaires are made when the stock market crashes, and now you can see why. On top of that, I think Google's earnings estimates tend to be on the low side. Analysts expect 10% earnings growth, but Google's earnings grew by 36% last year and 27% the year before that. Likewise, DCF models calculate the fair value for Meta platforms at a whopping $880 per share, making it 43% undervalued today and giving it a 75% upside. And again, that assumes 10% earnings growth, while they've actually been growing by more than double that ever since they stopped burning so much money on the metaverse. Another area of the market that's crashing hard is semiconductors, a very big focus of my channel. The Taiwan Semiconductor Manufacturing Company, or TSMC, makes 90% of all advanced chips on Earth, including Apple's A-series and M-series chips for iPhones and MacBooks, Tesla's chips for full self-driving, and of course, Nvidia's GPUs. President Trump issued a warning that tariffs on foreign chip makers are starting very soon, and they could hit 25% or higher. Like I've been saying though, I think this is more of a tactic to pressure TSMC into building more factories and chips on US soil, as opposed to a serious long-term tariff. We'll see how things play out over the coming months, but today, these headlines are driving TSM stock down to under $150 per share, while fair value is calculated closer to $225. That implies a 50% upside. The last company on my list is Nvidia itself, because it's trading at a PE ratio of 32. The last time it traded at a PE ratio this low was in 2019, when it was under $5 per share after adjusting for stock splits. Models calculate Nvidia as being 20% undervalued, but I actually think it has way more than a 25% upside in the years to come, and I've made many videos explaining why. But hopefully this video helped you understand what's causing the stock market crash, how long this crash could last, how to be greedy when others are fearful, and of course, give you some great stocks to think about once all this dust settles. because relying on data instead of your gut is a great way to get rich without getting lucky.